and Michael Kramer on X,
Hi.
Michael Mott CM. How you doing, buddy? This is your kind of environment. You've been talking about this happening for
Yeah.
quite some time.
Yeah.
I'm going to stop sharing so that we could have a little conversation. See your setups here.
Right.
We're pressing the lows. What do you think? We accelerate, or will the PPT help the market here generate some kind of rally? What do you think, Mike?
Well, I think I this market has the potential to go to 4,400. I mean, forget about 4,800.
Okay,
That's how overvalued it is in my view. I'm
okay,
happy to share some screens with you, but
go ahead. It's not letting you.
I mean, again, I'm not making it. No, I can do it. I'm not making it from a I'm not trying to make that point of view from a technical perspective, but just from a fundamental standpoint, right? If you try to think about
Yeah,
where value investors, we kind of always think about levels. For
right.
those of you that's been around for long enough, you kind of think about where's the levels where people who find value in the market might step in. And this is just a chart that shows the S&P 500 12-month forward PE versus the median, right? It should come back in a second, versus the median, the blue line's the median. And this is how far we're trading from the median, right? Seven
Yeah,
points. So, I mean, we're
yeah,
up here with, 2000 and we're up
yeah,
here with 2021 and 2020. I mean, the median's down here at around, 15.2.
yeah,
So, I mean, if you take, you know, I think the estimates are for like 265 this year times 15.2. You're talking about a 4,000 handle, 4,028 to be exact. So, I mean, from a fundamental standpoint, this market is, beyond overvalued. And so, does that mean we go to 4,000? No. But what it means is that there's that potential because that's where the value guys are going to say this market is, that's where a guy like me will say this market is ridiculously cheap now. It's too cheap,
right.
right? But up at these levels, you're not going to get those type of buyers, right? And so you're left with all the momentum guys who are really chasing this market. And I think everyone's become so brainwashed that markets only go up that, you know, no
They're
one's
buying dips. They're
they're
buying dips
buying dips, but
all the way down.
right. And unfortunately, I had a horrible experience of doing that in 2001.
Okay, yeah,
Yeah,
yeah. You have
didn't
to
work
get
out
hit
for
in it.
me.
Right. So yeah,
Yeah,
if
and I'm not
people forget how a
right.
bear trades because they haven't seen one in such a long time.
And for some of those people, they may have never seen one. A
Good
true, a
point.
true, a true, market correction where the market is so overvalued that you're not going to get that, you may not get that value type of guy to step in and really support it. And that's really the question, right? And we just don't know at this point. It's too premature to say that. But I think that what you're seeing in this market is it actually has a lot more to do with deleveraging right now than anything
Okay.
else. And
Right.
really, it comes down to a basic trade, which I'm sure you're familiar with, which is the Japanese yen.
Yeah.
And really, more importantly, I wrote something over the weekend and I talked about the spreads between, US tens and German tens, which have just
Oh yeah.
absolutely collapsed,
Right.
right? And if you do
Yeah.
this another way, 10-year minus, oops,
Yeah. So I mean, they're leading the way in rates. That's
right. So now
unusual.
German rates have really, exploded over US rates. And with US
Right.
rates coming down, that's causing, the euro to strengthen
Yeah.
materially,
Yes. And
right? So you
I'm
have
looking
like
for
this,
what would happen. Let me ask you this: Europe having up until recently with this big fiscal spend that they're going to make because they're concerned about Russia and they know that they
yeah,
have to count on themselves. Is a strong euro for countries like Germany going to be a problem because they're mainly an export market? But because we've had this, I think it's a generational shift or a reversion to the mean where money's flowing out of here and
right.
going anywhere else. It's being treated well in China.
Right.
The DAX has blown away the performance, and this is happens every 10 or 20 years. It's not an everyday event.
Well, right, and that's the thing. I think like what we're seeing is a shift. U.S. policy and the major shift that U.S. policy is implementing, which seems to be that of less presence on the global stage, or at least less of a less Europe is going to have to rely less on the US. That potentially means that, Europe's going to have to spend more. Now, the question becomes is, does the increased spending create enough growth to have them avoid, bigger problems from the stronger euro and higher rates? If it creates growth and the economy booms, then higher rates and a stronger euro won't necessarily matter, especially if that spending is remaining within the continent, right?
Okay.
If And so what we're seeing right now, in my opinion, is a repatriation of flows that were coming into the US that are now leaving. And another trade, so you have the euro trade going unwind right now going on. And of course, we have our friends in Japan who,
Yeah.
you're seeing right now, Japanese 10-year rates
Yeah.
are, I mean, have gone parabolic at this point. And so you're seeing those spreads really blow out. And you're seeing specifically the US 10 minus a Japanese 10 really breaking what I would consider to be some key support. Now, the reason why we didn't melt over the summer was because the BOJ basically kind of slowed it down. And right
Gave
now,
people a chance to unwind the carry.
right, we got to a point where we were starting to see that unwind. And then they came in and the BOJ kind of tapped on the brakes and said they weren't going to, raise rates when the market was volatile, when the yen was volatile. And, right now you're seeing the spread between US 10 and Japanese 10 also breaking down. But the problem with this spread is that it's breaking down and it looks exactly the same as the Japanese yen.
Yeah.
And so if you're going to be, and then of course, if you take the NASDAQ futures and you
That'll
just
look the
overlay
same.
them, I mean, it's basically this. So why is the market coming down? Is it really coming down because of growth fears? Maybe it's not helping the situation because 10-year rates keep going down here in the US,
It's
but
de-risk, more de-risking.
it's deleveraging, right?
Yeah, de-leveraging,
And
de-risking. Yeah.
so, when I look at that, I say this could have a long way to go, right? We're only in early innings of this because you know, you're
Yeah, I know guys
where
looking for 120 yen.
right. And actually, I mean, the
120.
truth is if the Fed comes in and starts doing what you're saying and gives the bazookas, and they start, and rates go down even further, that could just, even add to the fuel at this point.
Yeah.
My
That would
viewpoint,
accelerate the dollar decline.
right, right, because the
Okay.
rest of the world isn't going to be doing that.
Right.
The other thing that, was very clear to me that really that seems to be the major point, right? So I mean we can look at technical charts and the technical charts are going to tell us where the levels are, but they're not really telling us the real story of what's going on. And what I use a lot are these EAST1. This is basically the cost of financing equity, right? So if you want to go out and you want to leverage yourself and you want to, do that, you can do it through these BTIC on adjusted interest rate S&P 500 total return futures. This basically measures the cost of equity. So this is new in TradingView. I asked TradingView to add this symbol specifically, and if you have a real-time ticker, you can watch these things trade all day long. The S&P 500 basically trades with these contracts, right? So when cost of equity goes up, you have a lot of demand for leverage, right? When the cost of equity
Okay.
goes down, your demand for leverage evaporates. If you notice, when we got into that frenzy into the end of the year, the cost of equity soared.
Right.
And that was kind of like a major warning sign at that point that this market was getting so overheated, it was at risk of basically exploding. And what happened when the year turned after that, Fed rate cut, that Fed December meeting, the date that this peaked was on December 17th, and then it literally did an intraday reversal. Here's the 17th,
Okay.
here's the 6th, 17th, here's the 18th, and then we went straight down from there. And so
Okay.
basically everyone that was levering up was like, no, we're done because they realized that the Fed wasn't going to be cutting rates as aggressively. And so
Where
basically all the
Go ahead,
leverage,
Mike.
the demand for leverage essentially evaporated. And now on top of it, you have all this stuff going on, with basically euros and yen leaving the US. I mean, every time I think the euro goes up, every time I see the yen strengthen, I think about, the reason why that's happening is because people are selling US denominated assets and taking that money home.
What a big change. I mean, up until I don't know, January, actually, American exceptionalism. It bothered me every time I heard it. American exceptionalism.
Right.
Well, everything's doing okay except America now. So it's changed from exceptionalism to except we have a problem here in Houston.
Well,
So
when you look at the American economy, though, it's not really like in shambles, right?
no, it isn't.
It's doing quite fine. I mean, the February payroll report certainly didn't suggest that the world was coming to an end. I think a lot of it is overreaction. And I think a lot of it is just the world waking up and changing its tune because it realizes that with the Trump administration, the US is going to be less involved on the world stage potentially, or that, the US is going to be charging more for tariffs, making it less favorable for the foreign investor here in the US. And the world is just adjusting accordingly. I mean, it's
So
quite
then let me
possible.
ask you this, Mike. You're talking about this, and um, do you feel are you still a bond bear based upon what you just told me?
Well,
Or are you
that's the thing
neutral
I've been
now?
thinking. Now that's the thing I've been thinking about the last couple of days because
Yeah,
it's very clear if you listen to Lutnick and Besson, both Wall Street guys, right? Lutnick is from Cantor Fitzgerald, the president of
I
Cantor
remember.
Fitzgerald.
Yeah,
His brother was the one that passed away on 9/11.
nine, right,
And so Lutnick is the head of Cantor just until recently, and you have Besson, who was a macro guy, he worked with Soros and what's his other Druckenmiller, and they're telling you they want the 10-year rate to go down.
right.
So, the thing I'm thinking about is, am I really going to fight that?
Yeah, okay.
If they're telling you they want the 10-year rate to go down, then they're going to put the policies in to make the 10-year rate go down, I think.
So we need the recession. We need we need a growth scare to continue.
Right, and really, and it may be somewhat intentional because
Yeah,
again, they want not only would a recession or a growth scare, bring the 10-year down, it will just totally get rid of inflation and it will force the Fed to cut rates. So, I
okay.
mean, if that's their intention and they're telling you basically over the weekend, they realize that things may get bumpy here or that, we may see
It,
some pricing. The government, Trump is basically telling you he knows what the risks are and he doesn't care.
yeah, his buddies are short and looking to buy cheap. So
Maybe, maybe. I mean,
maybe,
I'm
yeah,
certainly scrambling to put together lists of things that I want to buy because, we know this market moves quickly and we could move very quickly to the downside. And you got to be ready because, you just don't go all in on one price. You got to kind of scale your way in. So, would I be a buyer of the market as it comes down? Yeah, at levels, I probably would be a buyer of the market. I have a list of stocks I've been following for years, waiting for opportunities to get back in them. And I may get those opportunities on this because I
yeah.
think at the
So
end of the day, the U.S. economy comes back out on top. I don't think we're going into a depression, I mean, so, maybe it means that, we've seen some sort of top in the market for the next year or two while the market sort of digests all these changes, valuations normalize. It's possible.
everything and anything. Where are you at on oil, Mike? Is that
So, I
good?
mean,
I
I
mean,
watch oil. I've been watching oil religiously for a really long time, and
yeah,
not because I want to own oil, but because of the importance it has on inflation. And this level here, going all the way back to 2019 at 66, is the level that matters most. And, you could even make an argument it goes back to 2018. And this is the level that matters. And who's ever sitting at this price seems to control the direction of oil. I don't know who it is, but it's almost like a delineation. You go below 66, it's going to be very hard to get back above it. If you stay above it, it's going to be very hard to go below it. So I'm not, in my view, until oil breaks that magical level, you have to just wait and watch. My guess would be that oil is already really oversold. When you look at it on a Bollinger Band, we traded below the lower Bollinger Band, and I think intraday we got below 30 one of the days. So, I mean, we're pretty close to being oversold on two different indicators, and we can't break 60. So, my guess would be is that we're going to probably see oil rebound and go higher because the one thing we know is that Europe's going to be spending more. China's trying to dig its way out of a hole. And so it's possible that even if the US puts more supply on the table, that global demand picks up at some point. I mean, at least that's what the chart is telling you. Until it breaks, I mean, it's hard to be bearish on it. If it breaks
Yeah,
and it breaks meaningfully, and you're talking about oil at much lower levels, you're talking about it getting into the low 60s, maybe taking out these low points,
that's what I'm looking for it to get to the
then
low
then 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 it's a
60s.
different story. But until you really see a break below 66 and maybe even a break below 63, I think it's hard to be bearish on oil.
Yeah, well, they're 63, 62. They're in the same ballpark. I think they're
Yeah,
just going to flush people. How I would trade it if you don't like to hear the ice crack, because I'll be just buying it down there. You wait for
right,
a breakdown, Mike, under these levels. And if you're bullish, you wait for it to get back above the breakdown so
right.
that you cleaned out all the longs. So
Yeah,
now
I
no
mean, I
one
would think if it got it back above 70, it probably. I think the US
100.
didn't they make an announcement last week that the US was gonna the energy secretary put in a request for $20 billion to start refilling the reserve?
I don't know, but that would be a factor. Good levels to do it at.
Yeah, I think
That
I
was
saw something
Biden's
on.
best trade.
Yeah, I think I saw something on Friday
Yeah. So
that
they'll
said
cover
that.
their short from over 100. That was a good
Yeah,
one of the best trades by a government official
yeah. Well,
in a
some
long
of
time.
these government officials are good traders.
I've seen their net worth, and in fact I've had a discussion that these guys make money in the market, and they don't even chart. They
Yeah,
just go to meetings
yeah.
and talk
I
to
mean, Nancy
people.
Pelosi is probably one of the greatest traders of all time.
Yeah, well, she replaced Hillary Clinton made this was in the
Oh yeah,
story from when we were younger, right,
I
Mike?
forgot about that.
She made
Yeah,
100 grand in live cattle, and they
yeah.
came and they asked her, "So Hillary, how were you able to do that?" And she said, "I read an article in the Wall Street Journal." Huh?
Wasn't
But
she also? Didn't she also invest in some? What was it? Whitewater or something? Was that what it was
yeah,
called?
yeah. Anyway, that broker got busted for delegating trades,
Yeah.
winners to his friends and influential people, and the other guys stopped out. Anyway, so we've covered crude. Any interest in the metals, Mike? The
Um,
miners, things like commodities, anything commodity
I
wise
mean, copper
with the
looks
weaker
kind of
dollar? Yeah,
copper
copper
looks
look.
kind of interesting, but
Yeah,
I'm not really sure on it yet because it doesn't seem like it wants to get through 485 or so. I
yeah,
mean, if it gets through 485, it's going to run to five and a quarter, I think, to go back to these highs. But until
yeah.
you do that, I mean, you're just kind of, you really risk coming all the way back down again and giving it back. I mean, that's the other thing too, right? If we're going into some sort of recession, why isn't oil breaking support? Why isn't copper
Yeah.
really coming down? Those are the things you really should see, which tells you that there's something else going on in the market. It's more than just really global recession fears. It looks like a deleveraging to me.
Okay. And we're only one part of the globe. I mean, there's copper demand everywhere, right?
Right,
So
right.
we could end up having a relatively weaker economy than the people that are stimulating.
Yeah, I mean,
We're
the other
actually
thing that's really
we're
interesting is
withdrawing that
lumber.
liquidity from our
Yeah, we
system,
are.
right?
Yeah.
And most of the other world's going the other way now.
Right. The other interesting one is lumber.
Okay, that's
You
a
see like the
Canadian
cup and
thing.
handle type of thing.
Yeah,
And
that is.
what's interesting about lumber is if you notice, interest rates have been coming down, but the housing sector has not. The HGX, which is the Philly housing sector, I use I use the CFD.
That
They
looks
have,
bad.
yeah, well, I mean, this gives you this gives you real-time pricing during the day, but um you can see this what level this is. And notice, even though rates have been coming down, housing has really been deteriorating the sector. And this has things in it more than just housing. It has some of the material pieces that go in it as well. And that's obviously because lumber is going up, and that's
Yeah,
probably bad for margins, right? But I mean, if you break this region in here, let's call it 640 to 660. I mean, why
yeah,
couldn't you go all the way back to 460, 470?
yeah.
There's no
You could.
support in this region. Very
You're
little, I
right.
would say. Maybe here at 575. But I mean, at that point, you're talking about, another 12% down and potentially returning to the October lows. I mean, that would be, so this is why I say, like, there's the potential for much further to go on the S&P when you start looking at things like this.
Housing. Yeah, they've
Yeah.
been under pressure for a long time, the builders
And
as well.
the reason why I watch this a lot is because it tends to be a good leading indicator of the S&P. I mean, it certainly called it out in 2018. Remember that?
Yeah,
We had that mini crash at the end of 2018. I mean, housing was horrible that whole time, just going down, going down, going down. And then the S&P finally caught up with it. But if you look at it even more from modern times, here, look at what happens. I mean, housing just rips to the upside, and the
yeah.
S&P slowly caught up. And now housing's been crashing again, and now you can see the S&P is just catching up to it. So sometimes it's a good leading indicator too.
I tell you what, Mike, every time you come in here, I see charts that I things I've never looked at before that either reinforce a narrative I had before I saw you
Right.
or change it. So,
Right.
really, some great inputs into what we should be looking for. Don't
Yeah.
worry about a depression. It could just be that's probably later. I was thinking we could go to 4,800, then the bazookas come in, and
Yeah.
then the guys that are talking 7,000, they'll
Yeah.
be giving up on their 7,000 call down there. All right.
Well, like they're already hedging. Uh,
Yeah.
Today I read
Yeah.
on Market Watch, Ed Yardeni, who has a 7,000
Oh,
target,
yeah.
is now saying we could have a flash crash.
Okay. So
Just got to
we
hedge
need,
yourself a little bit.
I have to wait for Tom Lee to get bearish and then I'll do something
Yeah,
on the
well,
long
that
side.
won't, that
But
probably
you know
won't
what?
happen.
I don't fade you, Michael. You fade Mike Kramer at your own peril. Because
The
the guy,
problem, the problem
it,
for me, the reason I've been so wrong on the S&P over the last, year and a half or whatever it is, 2 years now, is because I look at everything else and it just doesn't add up to what we're seeing in the stock market. And so it really makes it hard for me to get on board with stuff like that.
yeah. But then all at once, nothing happens, and then it happens all at once.
Yeah, unfortunately.
That last snowflake to start the avalanche.
Right.
So Michael has a great YouTube channel for you to be able to follow him. You have a service now too, right, Mike? You're
On
providing.
YouTube, I have a member area now too. Yeah. I
Okay,
just tried to make it easier, and I have a Substack as well.
okay.
They're both called the Market Chronicles.
A great guy to keep an eye on his work. You probably just saw the tip of the iceberg today when he comes in here. Oh, okay. Mike Green's with you. Um, okay. Yeah, second half. I think this is second half recovery is kind of what I'm thinking. I don't think we bottom until earliest mid-May and possibly out to June, July. And then
Well, look,
we
I mean, the thing
what do you
is,
think?
I guess, right, is that if we're in some sort of phase where the market is revolting and we're seeing dollars repatriate because of policy that Trump's being put in,
Yeah,
and he doesn't, and he says he basically doesn't care,
right.
then how can you
He doesn't.
possibly know where that's going to be?
I mean, if you think that we had supply chain issues during COVID, all with these tariffs, I've heard they have to change all the shipping routes.
Right.
They're going to have less of them, less ports that they're going to be using. We're going to end up with shortages.
That sounds like stagflation.
Yeah, it does, doesn't it? All right. So, Mike, uh, great to hear from you and real interesting charts on housing and
Yeah.
and that we're, we could relax. It's just a deleveraging, and your targets using fundamental analysis, which we don't get enough of in
Right.
here. It's all charts.
Yeah.
So thank you, buddy.
No problem. Great to be
Uh,
here.
all right, my trading warrior brother, Mike Kramer. Follow him on X at Michael Mott CM. Go to his YouTube channel. How many videos you making a week?
Well, every day for YouTube members,
Okay,
they're usually about 10 to 15 minutes long.
okay,
And for free, I do like maybe I'm trying to target like 3 free videos a week.
okay. All
So
right. So people think we have good chemistry together. So we'll have to do a YouTube together, either on
sure.
one of my, and really appreciate. Hope you have a great year, Mike. You know what I say to people?
What?
Let's have a good decade this year.
Yeah. Sometimes careers are made in less than a year, right?
Yeah,
So
yeah. All right, Mike Kramer, everyone, my
see you
trading
later.
warrior brother. Thank you, Mike.
See you
And
soon.
remember, everyone, don't just count your pips, count your blessings, and you could join the team in 18 minutes on the morning edge. See you tomorrow for Turnaround Tuesday. I have interviews every week. So Blake is kicking back in Mexico right now. Everyone deserves a break. And I think Greg is going to be with us tomorrow. So, lastly, you like my haircut? Can you tell I had a haircut? Someone said I looked like Dale from 1979. All right, take it easy, guys. All right, see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.